It is very strange looking at a giant photo of yourself on the screen. Actually, this is really fancy, way fancier than most venues I usually speak at. So I put on my best suit. This is actually the suit I got married in, and I still fit into it. All right, I'm going to start with something really boring. And you look at the slide, and there are lots of numbers and bars. All it tells you is that on average, the average active manager underperforms. And you're going to look at this and say, look, we heard this umpteen times over. This is old news. Let's stop bashing active management. That's not what I'm doing today. In fact, today, I'm going to be their champion. I'm going to hopefully convince you that they are really not the problem. Or at least they're just a very tiny part of the problem. And today we're going to turn our attention onto the rest of you. So today I am going to make fun of the other part of the ecosystem and explore the value of the financial advice that we collectively provide to our clients. I think thinking about whether a fund manager has outperformed a benchmark or not is actually in some ways really distracting. It distracts away from the bigger puzzle and the bigger problem we actually face collectively with our clients. And the real issue is the following. Evidence shows that regardless of what products our clients buy, they can buy managers who happen to outperform over a long horizon, or they can buy a crummy old index. The outcome is that investor outcomes have been poor, regardless of what products they actually bought. And that's actually really puzzling, but it's something that we don't talk about very much. It's starting to get some attention more recently, but I don't think it's getting enough attention. Now, in a snapshot, the following graph captures succinctly the problem that our clients face. Now, most of our clients probably don't keep track of things quite as well or aren't quite as good at math, so they may themselves not be aware of the issue. But if you summarize that, the blue bar is what our clients have been getting. It's what working with us, the financial advisors, they've collectively produced as an outcome to their wealth. Now, the orange bar is, of course, what's shown to clients. Right? It's what's in a fact sheet. It's what's in a client statement. Essentially, the orange bar is the reported 5-year, 3-year, 1-year trailing return produced by the manager. Now, what I use here are basically all of the mutual funds adjusted for any survivorship bias. So don't worry about if there's some funky things going on in the data. You hopefully can trust me that I've done this right. And so what we're comparing is what the manager has produced. That's in the orange. That's usually just what we call in our CFP and CFA curriculum, the time-weighted return or buy and hold return. The blue is sometimes known by another name called a dollar-weighted return. Now, if you want to think about it, it's really just the investor outcome. It takes into account the fact that, look, an investor doesn't just buy a fund and keep it forever. In fact, with the help of all of us in this room, they regularly look at different funds, assess whether that fund's doing well or not doing so well, whether it fits their risk profile or not, and they'll move from manager to manager, buy a fund, sell a fund. That results in the blue outcome. Now, hopefully, none of this is surprising to you because I have things that are more nuanced and more surprising. But what it says is, on average, across all funds, the blue is about 2% lower than the orange. It means the investor outcome has been about 2% worse than what the manager claimed to have produced for the investor. Now, all of this is already net of fee, so what you're looking at isn't the usual, manager produced gross of fee, investor received net of fee. Okay, the 2% is sort of just cost. No, all of the cost has been adjusted out, so the investor's already paid the fee. So this is net of fee manager performance versus net of fee client outcome. And then I'm not even adding what an advisor charge on top of that, right? This is just the funds that they held traced over time through all of their buying decisions. Why does this happen? Well, it can only happen because the buying decisions, when they occur, what they buy and what they sell hasn't been very successful. And if you want to think about what that is, well, that is activities generated either perhaps out of our own behavioral biases, which we probably heard quite a bit yesterday, and some of which I think is a result of the collaboration with, the advices that we've been providing to them. And we'll kind of explore just exactly what kind of advices do we usually give and what do our clients usually prefer to do. Now, something more interesting. So if you look at this graph, right, you'll notice the gap. So the gap between blue and orange is what we call the return gap. Right? The part of the return that had they bought and held on to the fund that they would have gotten, but they didn't. Look at how much the return gap is for a growth fund versus, say, a value fund. Now, I'll give you a little bit of theory in a few slides, but if you sort of just pay attention to that, at least it seems to suggest gaps are smaller for more educated investors. Or we can say gaps are smaller for investors who use more sophisticated advisors. And I'll explain why that is. Whereas the gap was larger for the growth fund. And so here I'm sort of making a value judgment a little bit. I'm assuming investors who bought a value fund, a small cap fund, were probably the one who went to business school or who used an advisor who went to a good business school where they were taught the Fama French value and small cap factor, and they go, I vaguely remember if I buy value funds and small cap funds, on average over time, I'm going to do better. So you see advisor and the clients who are aware of that fact seems to have a smaller gap, whereas of course if you slip through my class completely and you did not remember that value and small cap would be good for you on average over time, and you bought a growth fund instead, where evidence shows that on average growth funds underperform because we tend to overpay for growth, and the high valuation multiple generally don't translate into high returns. So if you bought growth funds, your gap's actually larger. Again, that may be an indication of lack of financial sophistication or lack of the awareness of the data that are intrinsic to financial investments. So kind of take a mental snapshot of the results here. We're going to come back and hit on this point again. But the key point from this slide is that investors have gotten less than they should, even though they received advice that caused them to do more than buy and hold. And so we're going to come back and question how is that advice generated. And then there seems to be some evidence suggesting that investors who are more sophisticated or who receive more sophisticated advice do seem to do slightly better than investors who don't. Again, we're going to come back and explore that a little bit more later. Now I'm going to do a little bit of mathematics just so that everyone's perfectly clear on what the dollar-weighted return is and how it's computed and how then the return gap is defined. So if you think about dollar-weighted returns, what I'm doing in this research is just to look at how a dollar sort of trace over time moves around from one product to the next. Right? So I'm not tracking a fund over time. Instead, I'm tracking the investor's wealth over time. And what I want to find out is, when he puts a lot of money to work in a fund, does he do so before the fund goes up or after the fund goes up? Right? It's obviously much more helpful if you put money into a fund before it goes up. Right? Not so helpful if you put it in after the fund's gone up already. And so by tracing your wealth over time and where it's gone, you get a sense of, are you making your manager selection choices well or not so well? And apparently the evidence seems to suggest not so well. So why does that happen, given all the help we give to our clients? And of course, the return gap just sort of measures kind of wealth-weighted, dollar-weighted outcome versus had someone just naively bought and held. So output of that calculation is, by and large, there's a return gap, and it's pretty big. It's about 2% on average. If you're more sophisticated, maybe it's only 1.5%, and you're less sophisticated and you bought expensive growthy styles, you're 3% behind. Now, all of this is actually easily explained by the following two set of facts. So on the very top, this is the Morningstar research, something they've done internally, and I think later on something that's been replicated by other academics. Now the gist of it is, If you buy a Morningstar Start report and you use that as the sole advice for selecting funds and managers, you would have the following really puzzling outcome. So first of all, show of hand, how many people here kind of use Morningstar as a way to just do some very quick fund research and fund screening, right? I'm sure many of you do, right? It's a very, very successful service that's been provided. Now, of course, you probably automatically assume that 5-star funds should do better than 4, and 4 should do better than 3, and so on and so forth, right? Intuitively, you'd like to believe that's the case, right? But the puzzling outcome is that a 5-star fund in the next 3 years usually underperformed the 3-star fund. Now, we know how 5-star funds are usually selected, right? There are a lot of qualitative metrics, but we also know by and large they're sort of the dominating factor that influence your star rating is your performance in the last 3 years. So that's really kind of on the fund side. You can say that's more wealth management. What about institutionally? Now, institutionally, we're able to get some data to consultants. So we're talking about big institutional asset consultants who advise on trillions of dollars, where their clients are not individuals who may not be as financially educated. We're talking about pension funds with their own staff, with their own CIOs and senior investment officers, and they're tending after hundreds of billions of dollars. So apparently, when large asset owners follow the advice of large consultants, they get about the same outcome in that the managers they choose generally underperform the managers they fire in the next 3 years. Now, this is not something that's unique to financial advice being provided to private clients. This is actually a common outcome for investment advice provided by institutional consultants to their institutional clients. So whatever is happening, whatever is driving this bad outcome, whatever suspect advice quality is being provided, it occurs at all levels. All right. So to quantify it numerically, these are some results I'd like to share with you. So the way these tables are generated, so I'm going to tell you the details, but really at the high level, all you really want to think about is the winner strategies are funds and or managers who've done well in the last 3 years. So think of them as your top quartile managers or funds. The loser strategies will be your bottom quartiles or funds. Now, we do some basic cleaning, so we're getting rid of funds that are about to shut down, funds that are no longer viable. So these are sort of funds with meaningful assets. They're likely to stay in business, but they just have poor performances the last 3 years. And the median will be everyone else that's kind of in the middle. So not the very interesting ones that you bother to buy or bother to fire. So the selection mechanism of looking at just recent past 3 years is actually, when you go right down to the core of it, what drives your star ratings and what drives your institutional recommendations. Okay. Now, surprisingly, what we label as the winners, right, those that's done really, really well, they're likely to go on a buy list, they're likely to be bought and recommended to clients, versus those that are on a watch list, getting ready to be fired or already fired. The subsequent 3 years' performance is actually about 250 basis points different, but the other direction. If you bought the winner funds, you're going to underperform on average over the next 3 years by 2.5% per annum, versus if you kept your losers or if you bought someone else's loser. That's a shocking outcome, right? Because how many people here, when you bring a new idea, a new manager to your client, show them past performances? If you don't show it, I'm sure your clients want to see it, right? And how many of you suspect that the primary factor driving a buying or firing decision is related to a client's recent experience of that fund performance? Probably most of your clients, right? And recognizing that, the natural heuristics that we use in selecting managers from the data, that heuristic is exactly wrong. So where did that heuristic come from anyways? Because it certainly wasn't based on someone's empirical research that says, if you bought recent winners, they'll continue to be winners, so that's a good idea, right? Because data actually clearly suggests the opposite. So where did the heuristic come from? As it comes from, actually, thousands, if not, I guess, millions of years of sort of evolutionary memory, where it's always been the case in every other aspect of our life, someone who ran very fast yesterday will run very fast tomorrow. Right? A lion that'll eat you yesterday, next time you see him, he's going to eat you again. So there's huge persistency in most things in life. With the one exception, financial performance. That's the one thing where past characteristics truly are not very suggestive of future performance. And in fact, what I'm telling you here is the past performance tends to be mean reverting, which causes any trend-chasing behavior to be completely counterproductive. And that's because there's a lack of persistency from past performance to the future. All right. So now we're going to tie manager selection into something else that I think many of you naturally believe you shouldn't do. So how many people here, so let's start first. How many people help their clients with manager selection? I'm sure most of you, that's your primary job, right? You help them select product, you help them select managers. And you think that's a good thing for your clients to do, right? Regularly look at different options, regularly looking at the managers they have invested in, whether that's working well or not. Now, how many of you would recommend that your clients do market timing? Right? Much fewer of you, right? And in fact, we know there's a sort of perhaps unjustified stigma or justified, I don't know, that market timing doesn't work and it's sort of a bad thing to do, or at least it doesn't feel very scientific. The interesting thing is whether we notice or not, we are all market timers. We are just very bad at it. In fact, if you think about manager selection, right? What is manager selection if not market timing? So if we think about how we buy a financial product, the common saying in our field is that financial products are sold, not bought, right? That's because there's just so many things out there. So usually what catches your attention are things that, say, a wholesaler come to you, right? Products that, someone sort of sent through a factory and say, you should take a look at this. It's done really, really well. In fact, if you think about it, when was the last time a wholesaler, a friend, a colleague, introduced you or shown you an idea that's actually done really poorly recently? Has anyone ever come to you and say, look at this fund. It really sucked the last 3 years. Most of you go, this is an awesome manager. Right? He's got the magic secret. He's got the secret sauce because he's, shot the lights out the last 3 years. That's usually how that conversation gets started. In fact, if you think about another level up, when asset managers are thinking about what should we launch this year, and all the different sort of, product management group comes up with ideas, do you think there's an idea proposal that says we really should launch this asset class because it's got horrible performance, it's only got bad news, analysts are ignoring it or have pessimistic forecasts, that's what we should do? No. Right? Usually in the product group, they think about, well, what's sold well? What are things people want to buy? And that's usually correlated with things that have done well and are easy to sell. And so what goes into sort of product management and product creation are things that's done well. Things that have good curb appeal, easy to sell. That on a fact sheet, whether based on simulation or actual recent performance of the asset class, look like a line that just goes up with very little variation. Right? Because that's what makes a good fact sheet that causes people to want to buy. And so all the way throughout the value chain, from product creation to the creation of the sales kit to you actually receiving the sales kit, it's mostly market timing. And the way in which this market timing exercise is done is that the best performing manager, the best performing asset classes they get resourced, and they get in front of you. So let me show you the next graph. Now, these are some of the standard styles that you're probably more familiar with. They're today wrapped into smart beta products, sometimes referred to as factor products. But just think of them as sort of different styles, different categories. You can replace them with industries if you like. You can replace them with countries, regions, so on and so forth. All work the same. I'm just going to take this because this is what I have data on. So on the bottom, just different categories. You got value, you got momentum, small cap, illiquidity, low beta, gross profitability, and you can relabel them as quality. The gist of it is 3 have done really, really well. So probably slightly newer in terms of concept, profitability or quality, low beta. And then on the left-hand side, these are the more traditional. So you got value, momentum, small cap, things that have sort of made its way into textbooks. By the way, we only up financial textbooks like once every 15 years. So whatever you see in books are really, really old knowledge. And mostly that's because it doesn't make anyone any money writing a book. So we update knowledge rarely in books. So these new stuff, you go, oh, I can see why the new stuff work. Right? They're not as well known, so it's not as crowded of a tray, hasn't been arbed out. And I can totally see buying old ideas like value investing, like small cap investing. That's been talked about. All the managers, all the quant managers already do it. It's probably been arbed out, and that's why it hasn't done well. So you could easily say the last 10 years is indicative of what it's likely to be. Old ideas don't work. New ideas are going to do better. And in fact, anyone who's showing you a fact sheet that looks like this is selling you precisely that message, right? What has done really well is kind of the new thing. It represents new knowledge, and this will probably keep doing well. And the old stuff, look, the data shows it doesn't work anymore. Now, if you look at the full sample, this is actually what is more likely to be statistically true. So instead of looking at 10 years, now I have to admit that 10 years for many people is a very long time. Now that I'm starting to do more business in Hong Kong, 10 years out there for people are like 3 jobs already, right? So that's many a career out there. And then when I tell people, look at the long horizon, right? In Asia, that's like 2 years. So this is nearly 25 years of data. If you look globally, and in the US, I can go as far back as 50 years, right? So that's a really long horizon. And what you see is average over many, many market cycle, the excess return delivered by these different styles, different factors, and again, you can change the labeling, all roughly the same, positive at least. And we can haggle over whether 2.19 is very different than 3.86. Even over 50 years, there's some noise. So I wouldn't be too fixated on the decimal points or even the first digit, other than on average, these well-known styles that seem to generate excess returns do appear over a long horizon to generate returns. And any short-term fluctuation, and I'll show you later, are truly actually just short-term. Now, if you sort of compare this, which is really talking about short-term performance, to that, and if this is actually the truth, which is on average these different strategies do create an excess return, but you're sold based on that, what do you think is going to happen? How do you go from this to this? Well, there must be some mean reversion, right? Things that do well recently, a lot better than you expected to, will at some point have to do a lot worse than you expected to, and things that done a lot worse than you expected to have to sort of mean revert back for it to sort of average out to this graph. And so that's going to be one of the key messages I'll run through the rest of the presentation. So mean reversion and why that makes us all really bad timers and results in bad outcome. So this is a graph of sort of the valuation ratio for an average stock. And if you sort of look at this as a way of understanding how value strategies work over time, so I'm just going to stick with value because I think it's easy and intuitive to explain. You'll get a sense of why we time so poorly and why, despite value has been known for, 80, 90 years now since Ben Graham, that premium still hasn't been squeezed out. That lemon still hasn't been squeezed dry. So the thing that probably makes the most sense for all of us to talk to look at, and for me to talk to, is this large decline in valuation multiple for an average value fund. So what was happening back here? From, say, the mid-90s to the early 2000s. There's a dot-com bubble, right? So you're not surprised that, by comparison, value stocks underperform the rest of the market, right? The rest of the market were these, large cap, mega growth technology companies. And so the underperformance of value means the valuation multiple of value funds actually got lower and lower and lower. Now, what do you think was happening to flows to value funds at that time? Out, right? Value funds were being redeemed. And in fact, many had to shut down because they were just bleeding assets so badly. And then what happened after 2000? Now growth collapsed and value held its value. And so relative to the rest of the market, value starts to come back and valuation multiple starts to outperform. Now guess how much money was actually in the system capturing a rebound? Little to none. And so most, when people got into the market, maybe they were balanced value and growth. Maybe they just got out of business school. They might have bought 100% in value, but they sure wouldn't have the staying power. Or if they had a financial advisor who just came out of Chicago, he wouldn't have the staying power with his client. Right? There'd be no assets in client portfolio in value strategies before the rebound. Now, this is not a one-time incident. What happened over here? What happened during 2007 through 2009? The global financial crisis, right? And again, which style was the biggest hit during that time period? Financials. Yeah, and many of the financials were value-oriented. Big dividend payers, generally, below median valuation multiple. So massive outflow out of all value-oriented strategies, out of anyone who held any of the cheap financials until kind of the bottom near 2009, and then the big rebound. Again, there were no assets in that category. So once you kind of recognize how funds flow in and out, mostly in a trend-following way, it's perfectly easy to understand why, on average, value manager says I outperform, but yet on average, clients who's in and out of those funds never make any money. And that's where the gap comes from, is we are actually really bad at capturing almost any excess return from any strategy, not because the manager's not doing his job, but because we're making it darn hard for ourselves to earn that premium, right? I was taught in business school that says, market's got to be perfectly efficient because you got these managers who are more rational, very well trained, understand data, understand financial history. They don't make as much mistakes, or any. So because of that, market must be efficient. The one thing we forgot to tell you is managers actually don't have money, right? Money comes from clients. So who do you think were the biggest seller of value stocks? Right here. Who are the biggest seller of value stocks right here? Value portfolio managers. It's not because all of a sudden they woke up and had to come to Jesus and go, I don't believe in value investing anymore. Right? That's not what happened. What happened was they woke up in the morning and they just saw more redemption coming through. And they say, these stocks are dirt cheap. This is the right time to buy. But he has no choice. And so what actually makes market inefficient and makes these strategies and these premium continue to persist and exist is that the end client, who are driving flows and therefore driving the buying and selling decisions, are never sticky enough for the premium to be harvested. And so this is a graph that shows performance. And again, I'm showing you value. I can show you other style and it will look exactly the same. And then in the orange these are flows. So basically, flows usually lag recent performance because usually investors don't immediately jump in and buy after 1 or 2 quarters of outperformance. They wait a little bit, and of course, wholesalers wait for 3-year rolling numbers to look really, really pretty before they come to you with a nice fact sheet. So that lag is not surprising. So usually, you don't even benefit from a little bit of that short-term overshooting and short-term momentum. You kind of waited for the momentum effect to even erode before you get in, and you're only hit with reversal. Yeah, and as promised, you can chart out all the other styles, and they all have this cyclical pattern to it. So mean reversion appear to be everywhere. And this is really kind of how our ecosystem works, right? For whatever reason, some asset class, some manager of a particular style inclination is going to have a strong return. By luck, by skill, doesn't matter. And what's going to happen is, of course, flow comes to that manager, comes to that style. And that's actually, in the short run, going to create some virtuous positive cycle because we know flow has to move prices, right? When there's more demand, that's going to push prices up. And so in the short run, flow is actually going to drive good return. But now, when you're looking at these good returns, you shouldn't think, this good return means there's more opportunity. Because how is return computed? Return is nothing more than price of today is higher than the price of yesterday. That's how you compute a positive return, right? So anytime someone tells you, this manager has great return, what I'm suggesting you to do is don't say, this manager is skilled. What you need to think about is, whatever he has bought from me is today a lot more expensive than yesterday. So high return for an asset class for manager, you should instantly do a mental translation and say, that just means it's more expensive today. So the question is, when someone comes to you and say, I have a manager who's generated a great return, you hear, I have a manager who right now holds a lot of expensive securities in his portfolio. I think that makes it a little bit easier for you to think about, is this the right time to buy? But of course, that's not what goes through most people's mind. What goes through people's mind is, that's alpha. That's going to happen again. And it's going to drive performance chasing flow. And at some point, it just becomes a crowded trade in asset classes or in stocks or styles that's become quite expensive. And of course, then begin the reversal of that cycle. And you have then exactly the opposite happening as poor performance now going to scare flows out of that style until it overshoots and gets too cheap, but with no assets in it. So that's kind of how our ecosystem works, which then leads me to this slide. So if what's happening is sort of people making bad timing choices, and that timing choice is in a way hidden from plain sight because it looks like you're just making managed selection. But once you realize what you're doing is embedded in your manager selection process because of the way the ecosystem works, you're mostly just timing poorly. So once you kind of recognize that, here's another sort of interesting graph for you to pay attention to, where there is the smallest amount of investor shortfall. The strongest pattern is investors or advisors who help their investor focus on lower fee products. So this is ranked by expense ratio. Their clients tend to face the smallest return gap. It's never quite zero, and it's never positive. It's always negative. But at least there seems to be a pattern here, and it's quite important. That advisors and clients who select funds and managers in the lowest fee decile tends to do a lot better in terms of wealth outcome over time than otherwise. And I think we understand today why that is. One, again, investors and advisors who focus in on funds over here tend to be more financially savvy, more financially sophisticated. And because they're sensitive to cost, what do they also do less of? They do less of trading. And what we know now is the more you buy and hold, the better is your outcome, the better you get close to the print and manager return. So why is it that when you're paying high fees, you don't have the staying power? So how many have read the book by Kahneman on thinking slow, thinking fast? Yeah, so a lot of what happens has to do with this decision making where if you decided that you don't know enough about something, then the rational choice to delegate. And once you delegate, something else kicks in your system. You're no longer accountable for the outcome. Someone else is. And it is very much human for us to see bad results and say, I don't understand this, so I delegate it to you, and you fail me, and I'm going to fix the problem by firing you, and therefore you get a dopamine hit, like I fixed something. Whereas if you bought a lower cost fund, oftentimes there you go, hey, look, I don't actually need to pay that much for performance because I kind of have my own judgment about the beta. I'm going to get into an index fund. I don't actually need a manager to create value. So you're delegating less, and in some ways you own that decision. And because of that, you're less likely to blame yourself. And so when there's short-term underperformance, when things don't quite go so well, you go, the market's probably just, a little too irrational right now, and things are going to go back to normal, and in the long run, I'm going to be okay. And so that's actually what's happening. There's sort of less delegation of responsibility out to managers when you focus on lower cost funds that have low tracking here, oftentimes index-oriented, versus where you go, I don't know how to manage, so I'm going to delegate to you, and you are on the hook for answering for bad performance. So again, as an advisor, just sort of think that through in your client interaction and in your own decision making. All right, so if we can't use performance to analyze funds and managers, but we're still in the business of providing financial advice, helping our clients select funds and managers, what should we do? Right? And understanding that it is, at the end of the day, whether you like it or not, manager selection is really a market timing exercise, right? Because you are choosing at a point in time whether you want to keep or fire a manager. So I'm going to show you this formula, and again, bear with me, it's not too complicated. So historically, the way we think about manager skill or portfolio alpha is that we think it's due to a hopefully persistent skill that's sort of inherent to a manager. So if you see good alpha, that means it's a skillful manager. And that's kind of what we learn in statistics. Right? You observe past return, and you say, that tells me something about future return. Right? Past distribution, future distribution, they're stationary. That's actually not true. What we know today is the way you want to decompose observe alpha is that there are actually two components. One is manager skill. Right? It's likely to repeat over and over again. Someone who's got insight, who's got a model that's sort of in here that gives them sort of gut intuition about what's going to work. That skill does exist. But there's another component, what we call the cyclical component. Now, the cyclical component is really just luck. Meaning sometimes you do well because you're lucky. Sometimes you do well because your style became in favor through no skill of yours. Money's flown in, it's pushed valuation up, it's pushed return high, and as a result, you look like a genius. Of course, sometimes it goes against you. Now, given that there are two components, right? So anytime you observe an alpha, it's some combination of random dumb luck and skill. The question is, well, how big is each component? So let's say if you observe a manager who's outperformed by 5%, how much of that do you think is usually attributable to skill? 2%? Anyone? So I just kind of set 2% as our handicap. How many think of the 5% outperformance is likely more than 2% is skill-oriented? How many think below 2%? Most of you are cynics. It's actually much worse. It's like barely even 1%, if at that. Right? Meaning most of the time when you observe outperformance, it's mostly luck. Anytime someone shows you a 1-year, 2-year, 3-year outperformance, statistically, we can do the decomposition, and it is mostly luck. In fact, it's slightly worse than luck because luck may not be mean reverting. This is mean reverting luck. Usually what happens is there's manager alpha that's sort of persistent, but it's completely masked by sort of this random luck of his style being in favor or his style going out of favor. Now, if it's his style being in favor, it just means it isn't so much that he picks something and the earnings growth for those companies were actually higher than expected, is that he picked something, and then the valuation multiple went up because that topic became hot. And when valuation gets very, very high, what happens? It comes back down, right? Because at least we know valuation is mean reverting, right? If you go to valuation of 40, at some point it has to come down to valuation of 17, because that's what on average stocks trade at. And because of that, now you should look at this graph. So I'm showing you the same graph you saw before with a slightly different eye. When someone says, hey, these styles, these new themes, these new ideas, they've done much better the last 10 years. What you really want to think of is that data is probably, first of all, skewed by sort of recent larger than expected performance. And then reminding yourself, but we know on average, these sensible strategies usually do well. And the fact that some has done abnormally well and some has done abnormally poorly tells me actually this. That is the cyclical component. The mean reverting luck component is actually more likely to do poorly in the future if it's done well before, and vice versa. Now again, the fact that I label things to do 2 decimal points is in no way, shape, or form suggestive that I have, future return predicting ability to 2 decimal points. In fact, all the number you see coming out of regressions I report here, or anyone who report any regression, is usually plus or minus 5%. So this is highly inaccurate, but hopefully visually suggestive. All right, so let me summarize, and then we can take some Q&A. So first thing I hope you got out of this was a renewed awareness of just how severe the problem in our ecosystem, in our industry, is around client outcome, because we don't talk about it very much. You get this vague sense that it might be true, but so little of it gets reported, because we report manager returns. That's what's required. That's what SEC says you should report. That's what we show our clients. But the fact of the matter, the big issue is not this manager underperformed, that manager didn't earn his fee. The much bigger problem is our clients don't actually capture what the managers generate. Whether they generate good return or bad return, on average, our clients seem to capture something like 250 basis points less than what the managers generate on average. And what's causing that return gap, what's causing that shortfall, is largely attributable to the way in which products are sold. Products are sold based on recent performance. We don't need to sort of beat around the bushes. That's just true. Whether institutionally or in the private client business, whether we want to blame the advisors or not, we certainly know it's what the clients want. So, if your clients think that way, it's kind of hard to go against the grain all the time. Now, embedded in the manager selection, really what we need to get honest about is it's just market timing, right? And that, again, has to do with how products are created, and then how fact sheets are created, and how the whole sales process operates. It is very much a trend-chasing, market timing exercise that we, the entire industry, engage in. We create what's done well. We sell what's done well. We don't sell what will do well because we sort of don't know what that is. And the data actually tells us what's done well in the past tend to do less well in the future. So this whole production cycle of ours happens to result in an outcome that whatever we produce and sell actually tend to have worse outcome for our clients in the next 3 years than otherwise. And of course, all of that is not because we do this out of malice, right? We don't. We actually do it out of, unfortunately, just a flawed understanding of how to measure skill. Right? We think skill is what happened the last 3 years, when a tiny bit, so tiny you can't actually measure it. What we actually have been measuring are just random, dumb luck. And it's the mean reverting kind. And hopefully, after this presentation with that knowledge, we can all collectively think about a different way of selling, a different way of providing advice, and helping our clients see what their natural, intuitive decision-making process, how counterproductive that is, and maybe collectively get to a better outcome. With that, thank you.